typical these days to close out an investments conference with a psychiatrist, as you might imagine. You heard, I saw at the beginning of the conference, from a panel of equity analysts. And then throughout the conference, you've heard from economists and strategists. And I think that we can't control what markets do. And what grows our business as financial advisors is not necessarily high returns unless you have astronomically high returns. What grows your business is the strength of your relationships, how well you communicate with your clients, how you do what we call strategic emotional communication. Now, there's a lot of similarities between what I do as a psychiatrist and what you do as financial advisors. We both have clients. We both have practices. My clients are irrational. It's true. Your clients are sometimes irrational. And when they are irrational is when they blow a hole right through their portfolio and when they rupture the relationship. So I want to start today with a game. And what we're going to do is show slides with words on them. I want you to say the color of the letters of the word. So say the color of the word you see. All right? And I want you to do it fast and loud. Try to impress everybody around you with how fast and how loud you are. All right? So on the count of three, I'm going to switch slides. 1, 2, 3. Don't make me do the drill sergeant thing. Come on. Blue. Loud and fast. Okay, we're going to try again. 1, 2, 3. Red. Good. Okay, one more time. Green. Okay. Yellow. Good. Orange. Good. Red. Oh, you knew it was coming. I'm a psychiatrist, right? I try to be tricky. But let's do it again. Now, seriously. Okay, so I'm going to flip up the next slide. Say the color as loud and as fast as you can. Remember, impress people, okay? 1, 2, 3. Blue. Good. Again, 1, 2, 3. Green. Red. Oh, come on. We're supposed to learn. Okay, we'll try it again. 1, 2, 3. Yellow. Oh, good. Good. Red. Oh, wait a minute. Sorry. We call that Clooney vision. All right, just want to make sure you're paying attention. So why did we do that? Well, as you can see, I asked you to say the color of the letters, but we don't follow instructions most of the time. We do what are called mental shortcuts or heuristics. We do what's simple and fast for our brain to do. We say, okay, markets are going to go up 12% a year. Oh, wait, maybe they're not. But remember, our clients have these types of assumptions too. We all have assumptions about the markets, about returns, about our relationships, and we have trouble shifting our assumptions when those mental shortcuts are no longer true. This is why people become traumatized when the markets drop 50%. And even though maybe it was at the limit of our Monte Carlo models what happened in 2008, clients are still very upset. How many of you have had clients call you now upset about what's happening in the markets? Raise your hand if you've had clients call you about the markets. Yeah, so most of you, right? And clients will say things like, I told you this was going to happen. I told you to get me out. They make all kinds of claims and statements that are emotional. And it's how you react to these statements that determines how well your practice will thrive, not only because of that one relationship, but because they refer other clients. If you handle that real situation well, that is what brings that strength to the relationship. You know the expression, strike when the iron is hot. Well, in emotional moments in the markets is when the iron is hot for you and your business. And it's how you strike that determines your success. So you've heard a little bit about me. I've written a couple books, and I've done research in neuroeconomics. And I think what's interesting and relevant to what we're talking about today is we've done research both on the individual level, how people make investment decisions on the level of the brain. So we've even done neuroimaging research. We've found that emotional centers of the brain are active with every investment decision. Every investment decision we make relies on emotional processes in the brain. Now, the key is when those emotions are too high, it leads to excessive emotional activation, and then we deviate from the rational decision. We've done lots of experiments in this realm. We always need our emotions for making decisions. Our best decisions come with emotions, like who to marry, which house to buy. People are most satisfied if they follow their gut, right? But when it comes to the markets, we're confused. We think, oh, we should anchor it on these numbers I've been receiving. Oh, we should go for this fund or that fund, but we forget that it's actually more about our clients and what makes them feel comfortable and stable. This is an image of the amygdala in the brain. Now, the amygdala is the fear center of the brain. Now, what happened in 2008 was our clients had activation in this fear center. It created a bit of trauma, traumatic memories. Every time since 2008, and this has happened to you too, ever since 2008, whenever we hear about, oh, Greek default, oh, Dubai can't pay their debts, oh, maybe Spain, maybe Italy, maybe Ireland, every time one of these comes up, it reignites this fear of what happened to us in our portfolio. But, realistically, Greece may be a small part of our portfolio, but it doesn't matter. Because of this fear, it opens us up to a potential contagion because everyone is ready to pull their money from risky assets. Now, more worrisome is what's the behavior that has resulted from this fear and this trauma. This is a cumulative chart of equity fund flows in both domestic and international. What you see is that the blue line is the S&P 500. The red bars are the cumulative amount of money that has either been put into or pulled out of equity funds. And you can see most recently, as the end of August, we're significantly lower than we've been ever in the last several years. Fund flows had been positive up until 2008. They turned negative, and they've just stayed negative and gone further down. Now, you've seen this in your own clients. They're not interested in equities anymore. Yet, our conventional wisdom is that we want them to take some risk of some sort because inflation will erode their wealth otherwise. So how do we talk to them? Well, keep in mind, they're also angry. Anger has a specific impact on how people make decisions. In particular, anger is associated with feelings of certainty. When clients are angry, they know what's wrong. They know it's the government. They know it's the European political system. They know what's wrong. And they're not going to argue with you, or they're not going to listen to your opinions. They will argue with you, but they won't listen to any feedback because they know what's wrong. What anger does as an emotion is it keeps them from taking more financial risk. If you want your clients to get invested in something, to take risk, you've first got to address their anger, even if you agree with it, and even if it's about something that seems completely different. If they're angry about politics, that has to be addressed in your conversation with them before you can actually get them to take any investment risk. In psychology, it's an effect called misattribution. People feel one emotion, like you had a bad day at work or in the markets. You go home. Now, at home, for example, you slam a door, or everybody seems so inappropriately upbeat. Well, that's because you had a bad day in the markets and you're bringing that negativity home and you didn't realize it. It's misattribution, and investors are doing this all the time.